site, tastylive.com. Welcome. Tell us what you're trading today. Did you buy the dip? Did you get all bared up and think that the end was nigh simply because it's September? S&P 500 only down by 0.5% now, 64.40 here in the after hours. Mark the close at 64.25, so the bounce continues, off by nearly 1.5% in the NASDAQ, now only down by 0.44. It's that indigestion after the end of summer. Volumes are finally back. 1.7 million contracts traded in the S&P 500 today, which is pretty nice if you can get it. Bond yield, the curve twist, but ultimately Treasury is a touch weaker. Is Trump alive or dead? Is China, Russia, Iran forming a new trifecta, a new alliance?
Yes.
Cool. Gold prices surged to a new all-time high. Silver prices have a nice day for themselves as well. Finally, we take a look at crude oil, which is bouncing. New geopolitical regime coming into play. Dollar firm, which is perhaps the most notable assessment of this all. Gold, silver, and oil up on a day when yields in the US dollar are pining higher. In any event, gentlemen, what was looking like a pretty ugly start to September, only about 3.6 Rutkins. Not great, not terrible. Dylan, hats off to you last week, by the way. Saw those interviews that you had with Guy Adami and Bill Fleckenstein. Very nice. I'd encourage everyone to go back and watch last Wednesday and Thursday's episodes if you haven't had a chance.
Thank you for lending me the real estate for the discussions. I appreciate it.
It was
great discussions.
Difficult, trust me. I was sitting by the pool and I was saying, this hurts. I can't believe I have to do this to let Dylan have the real estate, but I will do what's necessary for the company.
Ilya allowed me the real estate and he was generous. You were lazy and God knows what you were doing.
It was so terrible to do no heavy lifting, but merely to consume these interviews with a nice cup of coffee and a lean back in the chair.
Yeah. Oh yeah, that was great. Hopefully we'll do a few more of them. There's lots of folks we can rope in, I'm sure.
Looking forward to it. But for now, you're stuck with the two of us, Dylan. So let's just start here. Stocks off the lows. Yeah. Meek Mills is starting an AI company, but your response to that information was, of course, just to buy them up. So are we buying them up here in a spooky September?
Yes, absolutely. Yes. Take advantage of the dip. Call your friends, call your uncle, call your aunt. Get some money wherever you go. Look under the couch. Get in there and get after it, my friends. This is everything that you're going to get. All this spook is going to just open the doors to glory. So make your shopping list. Number one on my list, Google, by the way. I'm now a mad Google lover. Gone full Googler. But anyway, yours.
We'll get to the individual equities in a second here, but Ilya, this Monday reversal in stocks, there's some damage. It's a bounce from the 50-day moving average in both ES and NQ. Mm-hmm. Is this the market doing what it did in August, where it sold off around a weak non-farm payrolls report? Are we positioning for a weak jobs report on Friday and getting it out of the way now?
I mean, maybe. Certainly this is the first of September that the markets get to have, at least on Wall Street, that the markets get to have a cash equity open. So there's probably some laying out of positioning for the month. Lately, and this is a weather vein I check often, the comments in my YouTube have been, oh, well, markets are always down in August and September. Well, they weren't down in August, and over the past 10 years, it's about 50-50. So I wouldn't necessarily say that this is seasonality again and again and again, but September is historically a weaker month on average. Obviously, it depends when you take the average. If it's a 20-year average, yeah. If it's a 10-year average, less so. So it varies, but we are starting a new month, and there is seemingly a desire to reposition here. Now, is it for the non-farm payrolls report? Doubtful. The sort of dynamics we've seen really since mid-August, and if you want to go even earlier, really the beginning of August. We start August with, oh my God, these meta earnings are incredible. And they fade. And of course, leading into that, the Magnificent Six, excluding NVIDIA, fade. Then we get into August. CPI gives us.
Is Meta going down because of their earnings or because we found out that they have a chatbot that talks about sex with underage kids?
Well, that was later. That was later.
It feels materially important.
Meta surged 12% in a day on those earnings, and the markets couldn't make hay of it. It's not like the market didn't like the earnings. It loved the earnings. And the market couldn't make hay of it. For that matter, they couldn't make hay of Amazon or Google or Tesla or any of the other Magnificent Six. They faded all of them. Then the markets faded CPI after one day of gains. Then they faded Jackson Hole after one day of gains. Last week they faded NVIDIA after one day of gains on Friday. And we'll see what they do this week. But the dynamics seem to have been the markets. It's like that Simpsons episode with the flying pig. They get one piece of data or one piece of news and go, it's just a little airborne. It's still good. It's still good. And that's for one day. And then they can't make hay of anything else. There's no follow through. There's no trend development. We keep getting stuck. It's as though we can survive a piece of event risk, unless it's objectively awful, and we haven't seen one of those since the last jobs report. And outside of that, the markets go, oh, well, this could have been worse. And you get one day of rally. But if you look at, nothing has really gone anywhere. The S&P 500 hasn't really gone anywhere. The NASDAQ hasn't really gone anywhere for the better part of a month. So chances are we're looking at this jobs report and going, okay, well, we'll either survive it or we don't. But do we really have a reaction function here beyond a day? Maybe not.
And Dylan, looking back on some of the data for the month of August, it was a record month for zero DTE options trading, where on a daily basis, we averaged 2.4 million contracts a day, which makes up now 62.4% of overall SPX volume. It's basically an even split between retail traders and institutions, though retail traders have the edge with about 53% of that volume. What does it say to you, generally speaking, about the market overall and the health of the market when we are increasingly short-term focused? Is this making us more fragile or anti-fragile, as Nassim Taleb might put it?
You're asking me?
I am asking you.
Yeah, we are anti-fragile. I mean, there's no question. The market has trained the world to buy the dip at a level that I've never seen before. I mean, the amount of destruction that is required in the sell-off for it not to provoke immediate dip buying has to be so big so that any sort of surface weakness, 1%, 2%, 3% sell-offs, I mean, the level of resilience just from sentiment. I mean, so it's going to take a real trend of inflation data, not just a one hot number, but like an ongoing trend, or some sort of real, major change in economic policy, like we saw in April with Trump, and even that was short-lived. But absent some real material exogenous force in the labor market, in inflation expectations, or in basic economic structure for the United States. And without one of those three things, I mean, not just happening one bad number, one bad comment, one big miss, whatever, but a pattern therein or thereof, every single time this thing backs off, it's a buying opportunity. And that's something I would not have, a younger, stupider version of myself who was subject to thought and thinking would not have said this. But now that I'm older and think less, I offer my opinion very clearly, which is buy them when this thing goes. You buy them. I mean, I don't know how a man like Ilya, to his credit, maintains a healthy level of skepticism and has all sorts of thought-based rationale. But good luck to you.
Well, one of the more remarkable things about today's market, if we're going to think about the seasonality, and we'll go into that momentarily, it's how gold and silver held up and rallied so significantly throughout the course of the day. Even as equities reverse off their lows, the bid in the safe havens, so to speak, doesn't drop or fall away. So gold here now up at 35.99 and a half. Thinner markets after hours. It's not the spot market, but nonetheless, the push higher continues.
Yeah.
There's a really interesting note out from Dr. Data for today's cherry picks. I'd encourage people to go check that out. But is gold a safe haven in the market? He looked at a study showing the various thresholds, decline thresholds in the S&P 500. So over the past 3 years, when when the S&P 500's been down by 1% or more, gold's only been up 36% of the time. So gold and stocks have by and large traded together for the most part. If stocks are down big, gold's going to be down big.
This is my favorite thing to poo-poo over the years. This idea that gold is some kind of a safe haven.
Safe haven from something specific, not necessarily to sell off in equities, but something else that's happening in the economy or the market. In any event, it's $3,600 an ounce. This is an all-time closing high here. I was able to take off some gold calls today, which had been struggling mightily for the past several weeks with a few days to expiration. So not going to, look the gift horse in the mouth. But Ilya, this seems now like something important is happening if gold's able to do what it did today at the start of September.
Right. I mean, and I've flipped over my position. So I was basically looking to have exposure short premium either through calls or puts, depending on where we were on the bounds of this 5-month range. I mean, basically, gold hadn't gone anywhere since second half of April, and if we were near the top of the range, I was selling premium by selling puts or selling calls, and if we were at the bottom, going the other way. So the latest kind of version of this was selling calls near the top, and ultimately, obviously, we've had a breakout here, so I've flipped this over and I'm selling puts again. In fact, the trade managed to run so hard today that it gave me a chance to even make a little money by the close. I'm not going anywhere. This looks like a breakout, but it just speaks to, you wake up here on the West Coast, you go, oh, this thing is probably breaking out. I got to flip over this position before it eats away all the premium that I've received. And thankfully, I was able to get out still in the green and flip it over and make a little bit of money on the other side. That's how much conviction this move had. It's very interesting, by the way, that we get this conviction at a time when the bond market is across the board lower, and you get the sense that the dollar had a great day on haven grounds, not on yield grounds, because the likelihood of a Fed cut in September has only increased. It's 91% now. So all of this now starts to look a little spooky. And you sort of wonder if on the first day of September, everybody went, wait. So we finished August with a Supreme Court case on whether the Fed governor or a Fed governor can be fired by the administration. That's now going to the Supreme Court, most likely, the curious case of Lisa Cook. And then you get, apparently now, the tariffs going to the Supreme Court as well, because you get a court ruling last week saying they're illegal, or at least the tariffs contingent on there being an emergency.
Well, hold on a second. How funny is that, Dylan, that the tariffs were made illegal and the Cantor Fitzgerald boys were selling those contracts about the tariff reimbursements.
Seems like
What a
seems like it might have
coincidence.
been some kind of it's an odd coincidence, Dr. Vecchio. Peculiar and odd
Crazy
coincidence.
that the Commerce Secretary's former company decided to make markets and insurance for tariffs that would be overturned. And they're the
Yeah.
only company smart enough to do so.
Here's another interesting little
Little
tidbit
serendipity.
for you that's adjacent. FinViz,
Must be a coincidence.
a wonderful data provider, compiles data on insider buying and selling. Because, of course, you have to report these things when people inside companies buy or sell. This data has to be reported lest there be some sort of shenanigans. Well, at the end of last week, the entire board for insider buying and selling was red. Out of 200 transactions, not a one was a buy.
Are you suggesting that there is an internal dialogue within the Trump administration to arrange transactions that are financially beneficial to the individuals involved with the administration of said policies?
I suspect this could be what's going on. I don't want to point fingers.
Okay, we wouldn't want to point fingers.
People are saying.
Well, can we talk about I think the biggest thing, even though I know it's sort of market distant, but I personally I actually believe that the China, Russia, India meeting, which is, well publicized, was actually quite significant. I don't think that was nothing.
Well, can we get into that for a quick second here? Because
I would love to, because I definitely have the opposite side of this perspective.
Of course you do. The Reuters report today said that India has started to sell U.S. treasuries and replacing them with gold in their FX reserves as a response to Trump's tariffs.
Mm-hmm.
So we see weakness at the long end of the curve today. You see that gold is going up. Dylan, this India, China, Iran, North Korea realignment. Russia's in there. Why do we care about this? What's the big deal for the global, new world order that's coming?
There's a foreign policy theory that has been around for a hell of a long time, which is that you really just want to keep any sort of adverse counterparties at odds with one another. So as long as the various adverse counterparties are not aligned together, they're grossly ineffective in terms of coordinating anything. And I'm imagining what Ilya's counterpoint to me is, not to try to neutralize him or even speculate as to what your answer might be, is that they're not really going to be capable of working together because they have such divergent interests. However, I do think that they recognize a material opportunity to exploit the apparent fragility of the coherence of American leadership and have an incentive to align in a way that they've never had before. And while they have many issues, they don't have a currency that they can really use. There's no threat to the dollar, obviously, but they do have an incentive to accelerate their trading within the group. In a way, it just accelerates the momentum of the formation of a better organized counterbalance to the United States at a level that I don't think has existed ever in the past. And I think it adds, I think it reflects on the risk of having, such a long history of what I think as incompetent leadership in the United States, going back to Trump 1 through Biden and now Trump 2. You're looking at a decade-ish of, subpar, if not way subpar, leadership in the United States in a way that in the short term is irrelevant, but over time starts to present meaningful opportunity for counterparties. And the most meaningful counterparty in the mix is obviously China. And if China can enroll India in Russia, Russia is less relevant. Obviously, Russia's more optics, in my opinion, and more sort of like historical, like political status, but there's really no.
Well, I mean, they have nukes, so there is that.
They have nukes, but it's a paper tiger, relatively speaking, economically, et cetera. But economically, India and China are not nothing, even though they, even if it's only 5% of the country that is involved in the economy, when your population is 1.4 billion, 5% of the population there is 1/3 of the American population. It's 150 million people, represents 5% of the Chinese or the Indian population, which is nearly half of the number of people in America. And so again, there's all sorts of reasons why this won't take on the momentum necessarily, but I do believe it is a incremental, but not insignificant negative for the United States.
I mean, I agree with that assessment almost totally. I guess where I am looking at this is at the capability of this alignment. I do think that despite the fact that for example, India and China don't get along, they do have now a joint interest in exploiting the apparent strategic weakness of decision making and positioning in the United States in a way that neither one could hope to exploit until relatively recently. And this is a very powerful unifying force. There's no question. I completely agree with Dylan there. Russia is a paper tiger. They can't even manage to win a war against Ukraine. So not exactly the most capable, and economically a tiny fraction of a thing. So not exactly.
But they're window dressing.
But they do have nukes.
And they have the largest land mass, which is a breadbasket for China.
They do. And so to some extent, yes. What's the most sort of interesting here isn't that the U.S. is so well positioned as to resist a formidable challenge. The U.S. is not well positioned. In fact, that's why the challenge seems to be occurring, because there's been a smelling of blood in the water.
But you're telling me that enraging all of our closest allies and trading partners, and then pushing together all of the people philosophically and economically against us together to work together.
Not a recipe for our strength, no.
That wasn't a good idea.
Well, it's not a recipe for our geostrategic strength. If the recipe was for our geostrategic weakness, then it's succeeding. But not a recipe for geostrategic strength.
Oh, so you kind of triggered me there. Dylan, if the goal here was to push India and China closer together to make our allies less certain in our ability to lead the world, what would Trump be doing differently?
He would never have retracted first. There's a couple things. One, and it's a biggie, even though people didn't think much of it or whatever. I don't know what people thought about it, but the United States' moral position in the world as the beneficent rich uncle providing investment in Africa, investment in South America, for relative pennies, but America's sort of extension of goodwill via minimal but significant educational, healthcare, and infrastructure resources around the world, which Trump has basically come back and withdrawn as much of as possible and said, well, they're not paying for it. If you don't,
USAID was shut down this weekend completely.
No.
State Department killed it.
That function was, I believe, the most persuasive thing that existed for the United States as a moral that it was basically you're paying pennies to have the ability to influence the world. So one, I think the retraction of global goodwill because of the withdrawal of that investment is catastrophic and opens a massive door, especially for China, that's already been marching through that door for decades. If you go to the Barbados, all the medical equipment is Chinese. You go to South America, all the medical equipment is Chinese. You go to Africa, all the medical equipment is Chinese. That is just utterly an incredible self-inflicted injury for the United States that's going to be difficult, if not impossible, to recover from. And then the tariffs send a message of, we don't want foreign things coming to our country. We would like to do less business with the rest of the world. And so I would say the commercial signaling is stay out. The social signaling is we don't care about you. And the rhetorical signaling is you're on your own. You look at the J.D. Vance speech, the NATO stuff, all that jazz. And so I think you put together the rhetoric on from the executive branch on international relations with the tariff, with the withdrawal of the goodwill investment, you put those three things together and you basically create an isolationist view of the United States, which ultimately all of North and South America in the scope of the world is basically a frontier backwater. The entirety of the world lives between, London and Beijing. And they look at North and South America like some sort of frontier ranch. And if it wasn't for the US reserve currency and the robustness of the US economy, which is obviously hyper dominant, no one would even care about North and South America. And so doing anything to diminish the relevance of the United States when the United States is the only thing that makes that balances out the centralization of all power between New Delhi and Beijing is idiotic. And it's very difficult. It's almost impossible to acquire power like that. It takes, world wars and decades and currency games and all this, a lot of things. But once it's gone, you kind of lose it incrementally and then you lose it all at once. I think what people worry about the dollar, I actually think the dollar will be the last thing to go. Like the dollar won't actually, the dollar won't be the first thing to roll over in the sort of decay of American global relevance. It'll be the last thing to roll over. But
this is where I'll take the other side, is despite the fact that we're obviously doing things that are telling geostrategic adversaries that we are weak and ripe for a challenge, I think actually we are neither so weak as to be ripe for a challenge, nor so weak as to extrapolate the current episode in the long term. And that's not because we're strong, it's because, to Dylan's point, the major sort of pole of power on this other side is China. And they are not the pole of power that they appeared perhaps before COVID even. Because what they don't have at this point is an economic model that works. And without that economic model, they have nothing. So the problem in China, besides the fact that their economy continues to be built on a premise of cheap labor, they have, first of all, an aging population whereby that cheap labor is going away and is is no longer cheap. In fact, the population is going away at such a clip as to make their economy basically inoperable demographically before much longer, give it 5 to 10 years. Moreover, they've been in a deflationary state for 2 years running now. And it's, in fact, a bit more. And it's because at this point, there's no demand. So China cannot hazard a conflict with the US because the only way that economy still does anything at all is because it sells things to the US.
So, yeah, they've been in deflation for 2 years.
More. 9 quarters.
3 years. Dylan, the rates of home ownership among Chinese millennials has gone through the roof. Something like 71% of Chinese millennials own their homes. In the United States, that number's less than 35%.
Yep.
So we've avoided deflation.
Well, there's been a housing crisis. Those homes cost nothing, and the government is giving away money so people would buy them, and the economy is still in deflation for 9 quarters.
Sure, but I guess the point is that
What is the point, Chris?
In China, you can change, right? In China, you can change the policies. You can't change the party. In the United States, you can change the parties, but the policies don't change. Aren't they doing a better job addressing some of these things than the United States is, that arguably leaves them better positioned for the long term?
No, because they don't have the people to run that economy. There is absolutely nothing about Chinese home ownership that says absolutely anything at all about their ability to counter the
If we continue to pursue our own immigration policies here, will we have the population required to keep the punch bowl filled?
Oh, well, that's a separate thing, and this is exactly what I'm saying. I don't think the challenge is doomed to fail because we're strong. We're weaker than we've been possibly since before World War II in relative standing. But the challenge is insurmountable for a player like China. They're just too far behind. They did not get rich and powerful fast enough. The demographics are stacked against them in a way where the challenge seems doomed to fail. And that's not a statement about our strength. It's a statement about their inadequate firepower for the challenge.
But I do find
Okay, so they fix things with India.
Sorry, go ahead.
Go ahead.
No, I'm just saying.
No.
Ignoring India in this entire conversation, which is actually the largest nation on earth. And I know.
Well, that's what I'm saying. So they fix things with India.
Yeah.
Yeah. They get the they maybe get some immigration going on.
Interesting. Is
on a little ping pong between Delhi and Beijing and Bombay. Throw some Tata Motors here and a little
interesting.
You know,
India is a very interesting layer to all of this. If we are successful in driving India away thoroughly,
we have not.
You could make the argument that China could address their demographic shortcomings by essentially setting up factories in India, and they'll be Chinese run, but in India, and you could maybe see something there.
The Japan model.
India is notoriously incoherent. India has a very hard time actually marshaling all of its resources because of how fractious and difficult their regulatory state is, their politics are, and were you to find some unification there, this would be a different conversation. But at least for the moment, India is very difficult to harness as a single power node.
I mean, I guess the question is Dylan, are you buying India, China, Russia on these news? I can't really buy Russia these days, but when it opens up and the sanctions end, do you buy the foreign equity still? Because China did a lot better than the US did over the summer. China.
I don't think you are. I think politically it's relevant. I think financially the United States is the center of the world and will remain the center of the world for a long time to come. I think that the political shift can be decades before the economic shift.
Yes.
I think the economic shift is the last thing to happen, and it may never happen. But I don't think the economic shift happens early or quickly. I believe it happens later. And I think, if anything, the chart you're showing, if you're going to do anything, own gold.
I totally
That's
agree.
really that's where I'm landing on
totally
with this, Dylan.
Agree.
Dylan, this is really
totally agree.
We land here because the thesis that we've worked on for the past year and a half, 2 years plus, really going back to October 7th, 2023, right? Gold gets its pop right after non-farm payrolls because of Hamas's attack on Israel. And it really hasn't looked back since then. You sprinkle in the tariffs, Ilya, what have we been saying since April? If you're a country, and why do you have all these US dollars and treasuries to begin with? Because you trade with the United States.
Yep.
You want to recycle your dollars somewhere. And so at the margin, if you see less trade on the horizon, you still need to have something for your reserves. Maybe you're not going to add the dollars, but you're not adding British pounds. You're not adding euros. You're not adding anything else except for gold or Bitcoin at this point in time. And then you get this headline today, India selling treasuries to buy gold for their FX reserves. What more evidence do we need that this is like the predominant theme?
The writing's on the wall. I mean, clearly.
This is still the trade. This is the trade. If you are thinking that India, Russia, this is all a new world order.
If you think
gold is still the trade.
Right. And my point, I guess, is that you don't have to even think that. I don't think that. I don't think that India and Russia and China can mount a meaningful challenge. I think they'll try. But the very fact that there is a level of speculation and that there is a try and that price action is responding is good enough reason. Because frankly, it doesn't have to be about the meaningfulness of the challenge. The very fact that the U.S. has been so enfeebled internally from the inside out that this challenge is even a point of conversation is enough to say, well, you know what? Let's get some insurance for this is going to have to be a show and prove kind of challenge rather than a it's pointless to even attempt this. Why bother? The U.S. is an impregnable fortress. I mean, obviously, the challenge is significant enough that it is being mounted at all. And that already is a reason, and the price action is responding. So I don't think you even have to believe in the validity of the challenge or the capacity for it to be successful to look at gold and go, okay, yeah, we're going to have a speculative period here where this is a thing that we're going to talk about. Buy gold, as I did.
One of the problems that's coming up recently is about debts in the developed world. In particular, there have been some really odd movements at the long end of some curves in, say, the UK, or if you look to Spain.
Oh, yeah.
And it's pressuring the currencies now. The British pound was up by 0.87% today. We talk about a world where a lot of these countries are seeing increased deficits. The UK just announced that it's going to be delaying its budget. It has not been transmitted over to Parliament yet, so they're behind schedule. Delaying budget's not going to solve any of the problems, but it's one of those just headlines that like the government just can't get a grip on everything. Ilya, your enthusiasm for the US dollar has been well noted. And yesterday on First Call, you argued that the dollar is still in the middle of a bottoming process as it's been since July. Today gives us that bullish outside engulfing bar, even with all this talk of other countries selling their treasuries to buy gold. What do you take away from the dollar's action here on this Tuesday?
I think one of the most interesting things on the board today is you get yields higher, gold higher, and the dollar higher, because one of these things seems like it's wrong. And gold seems like the odd one out because it really shouldn't be rallying if yields are up and the dollar is up. The fact that it's able to rally in that kind of an environment tells you something about how strong gold is. But then you start to look at this in context and go, well, why are yields rallying? Are yields rallying for some sort of positive economic outcome? Is the dollar rallying for some positive economic outcome? And I think the answer clearly is no. The numbers that we got today, the only thing that we got was the manufacturing ISM. It was disappointing a little bit. It actually ate into the dollar's gains for a spell there until the dollar came back. This is not anything that is ostensibly predicated on there being less of a chance for a Fed rate cut. No, the probabilities for September only firmed up. We're at 91.7% now. So this seemed like risk aversion. And it seemed like the kind of risk aversion that's actually worried about, again, interestingly, sovereign risk in the US, which is how bonds didn't pick up a safe haven bid. Instead, it looked like a rising term premium sent yields higher.
And so then you're saying the dollar was tracking the yield bump? Is that your rationale for the dollar move?
Well, I think the yield bump, I think the dollar was not up because yields bumped higher for good reasons. If there was good data and a sense, well, maybe the Fed doesn't need to ease as much, then you'd see, yeah, yields are up, dollar is up, but then stocks would be up, and you'd get a general kind of growth positive vibe, and gold would not be doing what it's doing, almost certainly. Instead, bonds sell off because apparently we're injecting a level of uncertainty back into the bond market, and the dollar is gaining as a haven, which is really interesting in this context because it suggests we're not worried about the U.S. sovereign being incoherent. It's not sovereign risk. It's policy uncertainty risk. If it was the U.S. sovereign is being incoherent, we'd see April, late March again, where stocks, bonds, and the dollar go down at the same time. That the dollar is up in this environment is telling you this is not worries about the U.S. becoming a bad borrower, say, or facing a meaningful geopolitical challenge or whatever else. This is about uncertainty. And frankly, these Supreme Court cases and how front and center they've become over the past 24 to 48 hours, that smells like the catalyst du jour here. Any theory is as good as any, but this is not a dollar that's rallying because it's getting yield support. Because that yield support isn't coming from anything growthy. It's coming from a parallel spook. This feels like risk aversion. And you're seeing the dollar capitalize on that really across the board. The yen is down. The Aussie is down, albeit not as bad as it was earlier. Canadian dollar, pound, euro, you name it. Everything across the board.
Are we seeing increased sovereign risk?
I don't think so. The dollar wouldn't be up like this, I think, if we were.
Well, it's certainly not the incoherence that we saw earlier this year. That's
Right.
to your point. I think that makes a ton of sense. But Dylan, there's also a lot of incoherence in this policy still.
Sure.
You're talking about U.S. policy?
I think, yeah, U.S. policy. There's a lot of incoherence.
Incoherence.
All kinds of incoherence.
Incoherence is, it's like the Marshall Plan directive is incoherent policy, like the modern.
Did you see what Trump tweeted this
Incoherence
weekend?
is the policy.
Incoherence
Trump-
is demanded. But Ilya's point is it goes back to the financial crisis. However incoherent American policy is and however degraded American credibility becomes, the thing that keeps America above water on a relative power scale is the even worse condition of its primary rivals.
Yes.
Which one day might not be true, but it's true right now.
Yes. Yes.
Ilya,
both of those things.
How much money do we get? How much money do we do a year per year in trade? Do you know how much in the United States, in the U.S.?
With who?
Just generally speaking, because I've been trying to wrap my head around this tweet from the White House that Trump's policies have brought $8 trillion in new investment to the U.S.
What? Where?
Well, that's why you have such an incredulous reaction, because the economy itself, like, we have about what, $4 trillion in trade total, and so his tariffs have produced $8 trillion in investments in economic activity. Dylan, if they're going to just make up
and a
numbers,
bunch of these investments aren't investments. They're plans to do something over the course of a decade plus.
yeah. So
This stuff
to
isn't
put
a
this in
done
other
deal in
terms,
the best case.
I mean,
it's like when people
ChatGPT says the total value of all U.S. exports and imports is $7 trillion.
$7 trillion, and so Donald Trump's tariffs in just the past 5 months, because Liberation Day was 5 months ago.
And that's, by the way,
Just the-
imports and exports.
It's incredible. $8 trillion.
Unbelievable.
The nice thing
Dylan,
with basically a
amazing.
pretend presidency is you just say things.
Yeah, I mean, like, if they're going to make up numbers, why not go for something even more ridiculous?
I mean, 8
5 quadrillion.
A million, billion, jillion.
Okay, so
Yeah,
this is exactly
sounds
the kind of crap that took down the Soviet Union, for what it's worth, and I do need to opine on this. That
Yes.
when bad
Please
information
opine.
flows upwards, and people are saying like, oh, like, we can't tell the boss the real numbers because that's going to piss him off, and I don't want to get shot in the back of the head, so just tell him what he wants to hear. Decision makers can't make the right decisions because they don't have the actual information that's real in front of them. So I don't know who's feeding Trump this load of crap that the economy has had $8 trillion of investment and benefits from these trade deals thus far. But God save us if that's what he's being fed, because it means he's going to turn stocks are near highs, and we just made $8 trillion since April. Dylan, we can turn that dial a bit higher, can't we? Think of all the money we're going to make. How much higher can stocks go?
I mean, I would think they could go up to another billion trillion more.
Oh, well, speaking of which, Bank of America released their 2027 forecast today, Dylan. Do you think that they see the S&P 500 above or below 9,100 by the end of next September?
Above.
Above, they do. Correct. Good guess. Bank of America sees a 52% rally in the S&P 500 from now through the end of next September. Ilya, when we're printing S&P 500 9,000 hats, what will have happened to get us there? What's that world we're living in where Bank of America is correct? Something which, by the way, if you go over to the S&P 500 options chain right now, you go out to 381 days. We'll go 393 days, in fact, to the end of September. Yeah. And you were to look at 9,000 calls, they are one delta. So 1% chance of happening. In theory, we could sell a call spread up there, risk $50 to make 10,000. So why shouldn't we roll the dice, Ilya? With this one delta.
This looks like the kind of call that tells you that when Jensen Huang tells you that the AI boom is just starting, they're taking that statement at face value. Okay. I mean, assuming this wasn't a typo by an intern somewhere at B of A, I think it tells you that magical thinking continues to prevail. One wonders, obviously, where the magical thinking ends, but there's no telling when. I think another interesting kind of tidbit in this story is that we actually now have more ETFs listed than individual shares.
Wow.
In other words, we have more dishes than we do ingredients. We are so out there. Oh, and by the way, just in case that was not enough, there was some wonderful news coming out from the great Jared Dillion. I'm sure folks out there that are paying attention are aware. He's a great writer, former head of ETF trading at Lehman, and writes an excellent newsletter called The Daily Dirt Nap. And he points out that we've just had 21 new applications that Tuttle filed for income blast ETFs that seek to extract a options income juice out of basically synthetic long exposure. So
nice.
you get a synthetic long via long call and short put options, and then weekly you sell the near money put option and then attempt to extract income from receiving the premium. Now, these 21 ETFs, agentic AI income blast, crypto treasury income blast, meme stock income blast, robotics income blast.
Dylan, these are all the things that we want to see.
Are we not in a bubble?
We're getting okay. Well, the actual report here, so I use 9,100 as the line in the sand, but for the sake of shock value as we go out the show, the actual Bank of America forecast says the S&P 500 hitting a peak of 9,914 in September 27. What's their rationale? Folks, this is why they earn the big bucks. In the last 100 years, the average gain among 14 bull markets has been 177% over 59 months. And based on that data, because stocks are only up about 80% since the October 22 lows, to get to the average return of 177% over 59 months, they'd have to see the S&P go up to 14 by September 2027. So that's why we're going higher, because history demands it. That's as bad of a rationale as any. But you know what? Overtime's out of time for today. We'll be back tomorrow, same time, same place. As always, 4 p.m. Eastern, 3 Central, right after last call. So for Ilya Spivak in San Francisco, Dylan Radigan in Milan, I've been Chris Vecchio in New York. Good luck trading. Brief break. More Tasty Live after this. Ilya's here with Macro Money. See you there.
See you there, everybody.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
If you missed the live show, here's our cherry on top yearly recap.
So, we're doing the show on Friday, and the bat, he's doing the show in the morning, then he's going away afterwards, right?
Yeah.
He's all packing up the car, he's doing his stuff.
RV.
Packing up the
Packed
RV.
up the RV for a 6 to 8 day trip. We're supposed to be there about
4
48
days.
hours.
I bet him $20, and I said, you'll be in a hotel by either the first night or second night.
Oh, and then I vociferously stood up for you.
Of course you did. You should have, because that was the smart
I
move.
appreciate you. You're a good
Yeah.
sister.
Saturday morning, I look at my phone, and it says Venmo, $20.
I almost had to pay him $40 because there was a little stipulation. If we didn't sleep there one night at all, I'd have to double the bet. I almost had to send him $40.
What happened?
See what happened?
Here, what happened was,
We're driving up there. It's absolutely beautiful. It's like sunny as
Because
can be.
you were tweeting pictures.
Oh.
Yeah, it was
Like a
beautiful.
girl
It was
on
beautiful.
Instagram, you're like, I'm
Oh,
here
yeah.
in the woods.
Absolutely beautiful. Absolutely beautiful.
amazing.
It was gorgeous. We were gonna make a slight right-hand turn. We got about 10 miles to go, and up ahead there's like this dark cloud, and it's raining. It started getting muddy, and dogs are getting all muddy. Wife's having a little problem. Bugs are everywhere from the rain. And I realized at that moment that my wife was not a camping gal. Look at
Oh, that's a surprise.
So at 6 o'clock in the morning, I pulled everything out, closed everything up, shoved everything underneath, and I was home. We actually left because we did the show at 10 o'clock in the morning. I said we left at 10:30. I was home at 10 o'clock in the morning the next day. Look at him.
You were just
Jumped in my pool, looked back at my house, and I said, why would I ever leave? Why?
He was going to go fishing, catch
He's hurt on this one.
muskies, some bass.
Very quiet.
I left Friday at 10:30. I was back Saturday at 10.
AM?
Yeah,
You didn't make it 24 hours.
no,
Who broke down?
they all did. They all did. I rented a boat for Saturday, but the boat was broken. It rained for 5 hours. When we got there, it was.
Now the RV on rvtrader.com.
No.
Yeah,
Whoa, wait a minute. How do you get to Florida now?
I don't care anymore.
Oh my God. First of all, I'm sitting in I'm sitting in the captain's seat. I've never been invited to come sit in the new captain's seat. But what I'm concerned with is the size of these screens. And then he's still doing this.
Snow. Let's take a look.
They did not hold that rally at all.
Phil, you got a partial.
973.75.
I'm looking at this like I have to move my head to get through the top, the top symbols. I thought he had like a little computer and he was getting down.
He hasn't learned that he could swivel his head. He has to see the screen. He has to go like this to me. And then you know what? Money goes to money. You did it. Good job out of you. Yeah.
I just drove with him twice. Now I'm really concerned that I was just in the car with him for 2.5 hours. Okay, I need help understanding. This is the largest monitor that I've ever seen. I have to move back in order to see everything. And somehow when you're on air, you're looking at this, you need some help.
Nope, I got everything fine. The problem is I just have a lot to do. You see, because in your job,
Oh, here we go.
really all you have to do.
Get the full scoop by checking out the archives at tastylive.com.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
Zach, South Carolina, how are you, my friend?
Hey, I'm good, guys. I just wanted to let you guys know and Tasty Nation know that I've been following you guys for 3 years. Where else can you call two real traders? They pick up the phone and answer your question. They're so nice for us to use your platform. Thanks as always for what you guys do.
Love it, man. Thanks.
Thank you, man. Thank you. I really appreciate it. Very kind word.
Are stock markets finally feeling a bit weak-kneed? That's what we're going to be asking today on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And we've had some interesting price action here in these financial markets over the past two sessions. Friday, soggy. Today, the weakness continues. And when we start to look at what seems to be the catalyst, the situation gets ever more interesting, because putting a finger on something decidedly negative is not the easiest of missions. It's not like we got an unequivocally bad piece of economic data last week. It's not like we have a situation where there is a situation with the earnings or the geopolitical front where things are going in the wrong direction. But nevertheless, we seem to have the most potent 2 days of selling that we've seen since late March, which was, of course, that lead-in into Liberation Day and the bloodletting that followed. So what we're going to do is we're going to take a look at what seems to be at work here as much as we can make it out, and then take a look at what is expected in the days ahead to give us a little bit more clarity about where things may be going. So first and foremost, let's take a look at how these markets performed last week. And on the whole, things look relatively soggy, but not catastrophic once we take a look at the total results. So the S&P 500 down a little bit when we look at what's actually transpired here. NASDAQ down a little bit as well, but nothing like a huge destructive kind of a breakdown. Certainly not anything that would on net tell you that the markets had a significant amount of bearish conviction. I think when we consider here on the whole the performance across assets, what we end up seeing is a situation where the market, broadly speaking, continues the drive for lower interest rates. That's in the wake of the increasing conviction in the idea that we're going to get this rate cut in September. But when we put everything together here, the overall story looks quite a bit different once we start to unpick where these losses come from. And nowhere is this more interesting than it is in U.S. stocks. And you can see it here looking at the S&P 500. So here's Friday and here's today. So this is really where things start to get a little bit heady. And the reason that this decline is as modest as it is because, of course, leading into it, markets were kind of attempting to drift higher. And this is where things start to extrapolate on the conversation we've been having since last week, where it seems like really since the beginning of August, the markets are struggling to gain any kind of follow-through beyond 24 to 48 hours on any sort of meaningful catalyst, and thereafter they get stuck. And so we start with the markets at the beginning of the month fading what are generally good earnings reports from the first 6 of the Magnificent Seven. So we fade earnings, be they from Amazon or Google, or be they the explosive results from Meta. And in particular, those right here. There's a pop, there's a gap, and ultimately this comes apart. It happens again with CPI data, where we see the next big push. We take out these highs, we're not able to make any headway thereafter. We get another jolt from Chair Powell's speech at Jackson Hole, where he seems to endorse this idea that rate cuts are coming in the near to immediate term. Nevertheless, that fails to find lasting follow through. We get another nudge higher, courtesy of NVIDIA, which appears to produce at least something of an upside surprise, albeit it is the smallest margin of upside surprise for the company in going on 2 years. We still, at least, managed to come up with results that the market broadly judges are good enough. And so after a day of sogginess for NVIDIA itself, we erase most of its intraday gains and we come up with ultimately a positive response from the market as a whole. Nevertheless, we still have a situation where within just 24 hours, the move fades again. And so it is with this that we enter this week looking at this performance and going, well, it seems like nothing happened, but if we consider the event risk on the board, we have a pattern that's emerging. And the response function seems to be when we get a piece of news that can be rationalized away, we do so, but none of it seems to be giving the markets the kind of impetus that builds upside follow through, even as you continue to see this decline in yields, and ostensibly that the 2-year scores a bigger loss than what we have at the long end, tells you there's a level of urgency in rate cuts that's building into the system. In spite of that, incidentally, the US dollar manages gains up against the euro, up against the yen. Bitcoin telling a much more potent risk-off story, the high beta leveraged risk appetite sort of proxy that it is, down 6.9%. So the story last week, soggy in a modest way when looking at the averages, but dig into the internals and the price dynamics look relatively soft. It is with this that we start this week, and of course the performance at the beginning of the week here, this is just today's markets, not exactly encouraging. Stocks down significantly, although likewise significantly off the lows. We were down well in excess of 1% on both of the major indexes here, and clearly we've found a way to claw back quite a bit of lost ground here. Still, we end up with a down close on the S&P that the NASDAQ manages to erase almost all of it after hours. We nevertheless see that weakness prevails, and it prevails in spite of there not being a real meaningful catalyst to inspire it. The dollar only builds on strength, even as yields go higher with gold, which is a little bit incongruous. Typically gold, which yields nothing and is a kind of natural anti-fiat alternative, moves inversely of a strong dollar and of rising yields when that is the path for those. But clearly it still manages a strong increase. And so you get this sense of a kind of risk aversion binary in the markets today, where gold goes up, dollar goes up, stocks go down. Yields are the odd one out here. One would think they would be lower because bonds would catch that same haven bid, but that is not what is on the board. Raising the question about maybe there is an increase in uncertainty, maybe an increase from that in term premium and yields going up, not because of some sort of positive outcome, let's say a growth outcome that would diminish the need for Fed rate cuts, but going up for reasons of elevated uncertainty and a demand for greater compensation for that uncertainty from the markets. You do get a little bit of economic data on the board. The ISM manufacturing sector index comes out. It is a little bit soggier than expected, 48.7 versus 49 median forecast. So as ever, because this is in the logic of PMIs, where 50 is neutral, below 50 is contraction, above 50 is expansion, and the further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. The expectation versus realized result mix here tells you that you got the contraction as expected, but it was a little bit faster than the markets had benchmarked, if only by a hair. When you look at the internals here, you see that we've been running in contraction territory now for 6 consecutive months. Employment continues to shrink. It is well below the 50 line here. And the price structure a little bit better here. And on that basis, perhaps an increase in new orders. As the pricing structure here has cooled, so too new orders have rebounded over recent months, although they are still quite weak in terms of how fast the growth is going. But nevertheless, a little bit better. One wonders if this is happening because, as we've learned in the latest PPI data, companies are now passing through inflation costs to consumers rather than eating them. For the remainder of the week, we still have the service sector side of this equation, and that'll be an important touch point because, of course, services are a much bigger part of the overall economy than is manufacturing. The expectation that we're going to get a little bit of a pop here, a reacceleration, and the markets are going to be, as ever, very keen to see if that reacceleration exacerbates the sort of stagflationary messaging in the mix for employment and inflation within this data. If we take a look at how this has been developing thus far, we have increasingly on the service sector side elevated inflation. The latest numbers for this survey going back from July gave us the fastest pace of service sector inflation since going all the way back to August of 2022, whereas on the employment side, we are in contraction mode and, in fact, have been in contraction mode for a while. Employment expected to shrink again this go round, although the forecasts are still modest and the sample space for them is very small, so take those with a grain of salt. But of the past 5 months, there's only been 1 month of positive employment growth recorded for the service sector, and that was in May. Otherwise, from March through July, employment has been shrinking. And in fact, the pace of contraction in July hit the fastest since March. And so the sort of divergence between employment and inflation is telling us that stagflationary story that the Fed is so afraid of. But of course, the most important piece of economic event risk on the board this week comes from the jobs report. The expectation is that we're going to get 75,000 jobs added in the coming month. That is a hair above the 73,000 in the prior. The unemployment rate seen going up to 4.3% for the first time since mid-2021. So the overall situation here is seemingly relatively modest. 4.3 is, of course, high relative to recent history, but certainly nothing like a problem historically speaking. And so we don't really have a major red flag necessarily in that increase, why the Fed might seek to delay rate cuts. And 75K would be weak. We, of course, would need to look at the revisions, which have skewed toward aggressive negativity recently to get a more complete picture of the labor market. But of course, the concern becomes that the Fed isn't going to cut fast enough to head off what the markets seem to be worried about as an emerging downturn of significance. We can see here the markets now look at the probability of a rate cut at the September meeting, now only 2 weeks away, at 91.6%. The likelihood at this point, very, very strong, and this almost a foregone conclusion now. But where this data starts to become impactful is in the disparate setting for 2026. We can see that the Fed has been saying since December last year that it wants to do 50 basis points in rate cuts in 2025, and the markets are basically pinned around that and have been going all the way back to essentially May. There's been a little bit of a divergence this way, a little bit of a divergence that way, but the baseline here has held quite firm. The big difference instead has been in what's been going on here. in the outlook for 2026. The Fed said as of June, the last time that they updated their forecasting on this, that they're only prepared to commit to one rate cut in the forecast for next year. And when we look at what the markets have, clearly they are veering on 3. So the markets are ostensibly concerned that the Fed is not going to ease fast enough, that the Fed is not going to provide enough stimulus, or that at the very least they haven't owned up to the degree of easing that will need to happen. The markets clearly here saying, well, we're prioritizing dealing with a growth scare. We're not worried about an inflation scare, because what the growth scare will do is bring inflation lower. So this much seems like the critical sort of reaction function on this data. And so if we, for example, were to end up with a jobs report that were to deviate significantly in the negative direction, well, then the risk would be that the Fed is not going to commit to all that the markets are showing here, in particular, if we continue to get divergence between the inflation situation and the growth situation. What we've just heard from Fed Chair Powell, in fact, signaled significantly that the committee is more so concerned about the inflation piece than they are about the growth piece, even as they begin to ease. And so this sort of disparity would create the risk that the Fed is not going to deliver enough soon enough for the markets to get the backstop that they want. And this, of course, would be a reason for consternation. We likewise would see a sort of soggy response if the numbers were not as weak, but perhaps closer to in line, or perhaps even a bit stronger than expected, because for how much the markets want these rate cuts, if the probabilities in the wake of this data start to get pulled back a bit, even in relative terms, then perhaps the markets would get a little bit uneasy with that perspective, though that's probably going to require a very fine balance of data that's just a bit warmer, enough to get the Fed thinking, but not so bad that it would convince the markets that actually they don't need the rate cuts that they've been pining for. And that's a more delicate balance. In any case, what seems relatively clear here is that the markets are entering this week on soft footing, and that their capacity here to keep building higher, probably, given sort of the pattern that's developed since the beginning of August, will very much depend on event risk going in a tolerable way. And so looking at these ISM figures and looking at these jobs figures ought to be critical, and watching for their capacity to deliver follow-through even more so. Because for going on a month now, we've seen tolerable event risk give us 24 to 48 hours of exuberance, only for that to hit a wall and retrench. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go thereafter. Likewise, writing for the news and insights portion of tastylive.com. Commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
I distinctly remember getting an email from Tasty that Look Back had just been released, and I was doing the most laborious back test on the face of the earth before that. And I did 2 or 3, and I saw how quick it was, and I saw how quick the data was, and basically instantaneously, like, I was hooked. I'd always seen all the stuff on Tasty Live with all the data and all the value I thought that bring, and then it was all of a sudden I could control that and basically make my own segment for myself of what fit. And that democratization technology, I think, drastically changed not only the landscape of what's out there, but drastically changed my ability to learn at such an insane rate. And that's kind of when I developed a little bit more of my own path. I was like, this is the type of trade I exactly want to see, or I'd get some type of inspiration from Tasty Live to look at that. And that's when my consistency went from like 1 to 30, and I haven't had an unprofitable quarter since.
Calling all traders. Are you using Tasty Live mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, Tasty Live has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities, and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you would like the chance to share your trading journey and inspire others.
What is going on, everybody, and welcome back to Risk of the Week, or Risk and Reward. We got a new Risk of the Week. Today's Tuesday. We got a couple names we're going to get you guys' thoughts on. But before we get into all of that for today, Gus, my brother, how we doing today? We had a long weekend.
We did.
It was a little quiet.
We did have a long weekend. I thought it's Monday all day, which is a double whammy. It's a double whammy because you keep doing things that you think you're supposed to do on a Monday, and then you're like, oh, it's not Monday.
Right.
And like streaming, like this is very strange to come in on the first day of the week and be on air with you in our Tuesday, Thursday slot. But the other side of that equation is every time I remember it's not Monday, I'm like, heck yeah, it's not Monday.
Exactly.
So, it's give and take. But red day in the market today, first solid red day we've had in like a while. I mean, which is funny to say, but like it started to feel like, a 0.25%, 0.5% red day is like a pretty substantial red day.
It feels like
in the state of this market. And all of a sudden I see a 0.8% red day, and I'm like, the sky is falling. Are we going to fall apart?
It's funny you mentioned that because we also got bought back up. I mean, we put the low in today just right before 11 o'clock Central Time, and we've been bought back up and closed into the close strong, and we're still heavily down on the day. So with that being said, the market has been taking some aggressive moves to the downside. It was a 3-day weekend. Gus, anybody else that's in here, don't lie, who opened up their platform and recognized that today's not a full regular trading day. Did anybody open their platform on Monday? I think it happens to the best of us.
I definitely didn't myself.
Okay.
I was fully in tune with the fact that this was Labor Day weekend, but I will say that was something that I would do all the time when I was just a trader, like before I started working here.
Yeah.
But now having my like trading schedule tied into my work schedule, like knowing that if we're closed, the market is closed, that does well for me.
No, 100%.
Bob, Lone Sophos, Emmett, good to see you all in chat. Bob, go Buckeyes is right. I hit the nail on the head with that one. Buckeyes in the under. That was sharp. Happy to hear that you tailed that one.
Oh yeah, what's going on, Emmett? No, I mean, as we get in for today, I see we got the platform right here. We can actually just do a quick tour to market, and then we'll get into some of our risks of the week. As you can see here, we got SPY getting bought up into the close pretty strong, but I mean, we gapped down, sold off even more, put in the low right before 11 o'clock, and just ripped to the upside since. VIX, a little disappointing, but showing a little bit of promise heading in on this Tuesday, right? I mean, we got the spike in volatility over the weekend, and then the market's just ripping into the close, and volatility's collapsing again. But volatility tends to cluster, so maybe volatility picks back up. Hopefully, this is a sign to, or hopefully it's a sign that the market is going to offer us lower lows for the sake of a couple of the positions that I have right now. And then maybe we get that pop in VIX. You haven't taken a look at VIX in a little while, right?
No.
It's been a minute.
I mean, it's just, it hasn't really been worthwhile for some time for me to be looking over at VIX too much. But yeah, we got a nice little spike as a result of all this action. It's just, yeah, I don't know. It's
been quiet.
It's such an interesting market too, because like I am just so aggressively bullish until proven otherwise at this point that like a day like today is like a pretty freaking bad day for my portfolio.
Yeah.
But I know that you're on the other side where you actually are short and need things to move down, and this like isn't enough for you. So
Yeah.
it's just, we have a very interesting dichotomy going on here.
100%. With that being said, I mean, we'll see what we get for the rest of the week. Like, kind of to the point that you made, Gus. I mean, with such a big down move, I'm now just barely break even, right, on the QQQ position. It's like we had a massive down move today, barely break even on that. We got some Apple in there. I did take it. Look, I did get a little bit of long delta on though. Last week when we got the sell-off, I told myself I'm going to take advantage of this dip. I didn't take advantage of it in April when we sold off. So I was like, you know what? Let me get some long delta on an Apple. So we did that when the market sold off last week. Celsius, this was one of the risks of the week that we did, which was pretty fire. Celsius has been selling off a little bit more, put in a little bit better of a day for today. And now we're getting close to 50% of the potential profit on that trade. So maybe we take that one off tomorrow.
Yeah, the Celsius High Noon Corporation, is that?
The Celsius, exactly.
That's what you're talking about? Okay.
That was the headline that we were talking about. Let's quickly see how that panned out.
I don't remember exactly when that was. I'm sure we'd be able to see it. Maybe that gap down.
Let's see.
Yeah, for those unaware, we talked about it on stream some weeks ago, but Celsius had an incident where they're canned in the same factory as the High Noon vodka seltzers are
Something
canned.
light.
And there was one specific Celsius can that had a run where it was a Celsius can, but it had High Noon inside of the can.
Yeah.
On like a specific blue raspberry flavor or something. But anyway, yeah, Celsius. I can't believe this company has survived. I mean, I was like reasonably
Celsius?
certain. I was reasonably certain Celsius was going to go bankrupt like 2-3 years ago.
Really? Why is that?
They had a whole. There was like a whole legal thing where the FDA was involved, and they were like they didn't like what Celsius was putting in the drinks. Maybe they had to change their formula or something. But I remember though at Texas A&M. Celsius was like a big sponsor of all the athletics and everything. And so there was always people like around campus just handing out Celsiuses. Like you'd be walking to class and then there's like, like the Red Bull girls or whatever. Like somebody just gives you a Celsius.
Yeah, I know exactly.
Yeah, but I remember when they were starting to go bankrupt. Did they file bankruptcy? Am I crazy? Can somebody in chat confirm? Did they file bankruptcy or were they just close to bankruptcy? I know that Celsius was about to go under at one point. But when they were about to go under...
There was a massive rebrand.
Is that what it was?
I think there was a rebrand to where they changed most things to for Celsius. Yes, I think you're 100% right. Let me fact check it though.
When all that was going on, for whatever reason, they started like really forcing these Celsius cans on us, like the people around campus. Like they were clearly coached to be more aggressive in getting us to take the drink from them. And if you politely decline, they'd be like, no, like take one. And then also if you said yes, they'd be like, you want like 3 or 4? And so I don't really know. I never understood the calculus on that. Because how does giving away more free drinks, how is that conducive? Right. It never made any sense. I don't know. Maybe they were just trying to get more aggressive with their marketing.
Okay. I got you. So yes, anybody else can fact check this fact too, right? I'm going kind of quick here. But yes, the energy drink company Celsius almost went bankrupt multiple times in the late 2000s. In the early 2010s before it became a success it is today. This happened several years before the crypto.
That's all like 2010s though.
Hold on, guys. let me get to the bottom of this. But I do know Celsius did a rebrand where they were focusing more on like something to where it kind of boosts your metabolism, kind of taking like that fitness category route. And I know they saw a lot more success there. And I think it was a lot of like the marketing department. They made some changes and then took off. I don't even think they made big changes to the product.
Interesting.
I think it was just the marketing. I mean, turned the whole company around. It's crazy.
Yeah, interesting.
Crazy.
Bob, no idea about Celsius. I'll stick with coffee. I'm kind of with you on that one, Bob. I have an energy drink every now and then, but it's never Celsius. I don't know.
I just ordered a 21 or 18 pack of Celsius. It just arrived yesterday. So
interesting.
We're reloaded for the week.
Also at A&M, one time at a basketball game, we were like the Celsius Power Row or whatever. Like they pick one row of the stadium and they give us all a Celsius and they put us on the Jumbotron.
Right.
And this basketball game was like an 8 p.m. start time. And we would do this Power Row thing at halftime. So it's like 9 o'clock on like a Tuesday or Wednesday.
Yeah.
In the middle of the week. Then they just come to us and they hand us all Celsius and they're like, yeah, when the cameras come on, you got to chug these things. Everybody got to go crazy. You can shotgun it if you want. Like, just get amped. And I was like, I'll get amped, but I am not going to shotgun this energy drink at 9 p.m. on a Wednesday right now. I don't know who you think I am.
Yeah.
I just I feigned a little shotgun. We were on the end of the row from where the camera was, so it was easy to get away with that. Then just stocked those and had them at a later date. But but there was plenty of people, everybody on our row. Like we were in the vast minority. Everybody else was slamming.
I just can't do the shotgun with the energy drinks. I mean, the carbonation it's the carbonation. I feel like the carbonation's stronger in energy drinks.
It really varies because I know like Red Bull, even on the cans, it says lightly carbonated. Like that's kind of like part of their pitch.
Have you noticed they're a little lightly carbonated?
I have. I mean, I have Red Bulls around the office sometimes because we have them. I
peep that. Yeah.
Yeah. I'll whenever I have one, I don't like carbonation at all. So I try to whenever I pour a soda or a Red Bull or anything carbonated, I try to like get it to bubble as much as possible to get some of that carbonation out. So I'll just turn a Red Bull straight upside down over ice, and it has like no head on it at all. But whereas like if you did that with a Coca-Cola, you'd get it like halfway full and then have to stop and let it go down and do that a few times. So it definitely is lighter on the Red Bulls.
I gotcha. We'll get into the risk of the week right here. I don't want to give away what my risk of the week is too much as I'm on the position right now. But
Errol's about let's flip over to slides here.
No, we'll go ahead and shift over to slides. As you can see, the down day was pretty helpful for today. We'll see if the market wants to digest that into the rest of the week, but we can switch on over to the slides here.
Yeah, so as always, risk of the week. Those who know, every week we put on one high risk, high reward position. Let's dive straight in. Is yours first? Arrows is first. Go.
There we go. So, give me 2 seconds just to load right here on my end. My risk of the week this week is going to be gold. Some might say, well, gold is ripping into the close, and gold is absolutely ripping into the close. Sorry, let me let this load. Gold is trading at, I know. Gold is trading at the highs right now. I wanted to sell an out-of-the-money call spread, just get a little bit of short delta on. I don't feel, right, not that the market cares about our feelings. The market slaughters our feelings, but I feel like the market, there was a little bit of an overreaction today in the gold market at least. So I feel comfortable doing that, pretty decent premium. So I sold it in GLD, not GOLD for anybody that knows. If you know, you know. This was a definer's position, so I feel comfortable trading a market like gold, especially as it's so volatile to the upside. And we're hoping this is going to be more like a little blow-off top at all-time highs that we're looking at right now. And we're hoping that the Fed cut is priced in. Or whatever the Fed is going to do, we're hoping it's priced in. So hopefully it's an overreaction. Hopefully we cool off a little bit, but it is defined risk. I collected about, I think it was $1.77. It was, collected about $1.77. It was a $5 wide defined risk. So we got a little bit of risk on that trade. And gold at its highs is definitely a risk of the week for me. Gold at its highs, because gold can be a different beast when it catches some momentum.
Yeah, Bob, I'm long-term hodl on gold. That sounds like it's going pretty well for you right now. Then, Errol's taking the contrarian angle here.
Long-term hodl gold is definitely a move. I like that. I like that, Bob.
Gold only go up. In the long term. But I can see this position having some credence to it. And this is kind of a cyclical market. You know, if you catch the right few weeks span, like you said, I mean, it can really move.
Yeah, no doubt.
Yeah, it's an interesting one. But
what you got? What do you got for us?
Also, it just should be GOLD, by the way.
It's just right.
I've been saying for a long time it should be GOLD, should be the ticker for this, and silver should be SILV, not SLV.
It's SLV, right?
But SILV.
Yeah.
You have the room, especially gold. The word is gold. Like, what if your company was called, like, I don't know.
I mean, we have a gold, but they're on my head every time I trade GOLD instead of GLD or the futures.
I know it. Anyway, all right. Moving forward. My risk of the week, and I actually have not put this on yet because I'm playing a post-earnings trade from earnings that happened today after the close, is Zscaler. Zscaler, had earnings today, reported strong numbers. They're up 3 to 4% in post-market action. I'm going to get short tomorrow morning at open, but this earnings call, I've never seen anything like this, is very, very strangely similar to their last earnings call in May. In May, they beat EPS by 11.64% and beat revenue by 1.74%, and this month, just today, they beat EPS by 11.25% and beat revenue by 1.74% again. Same exact revenue beat to the 100th of a percent, which is very interesting. So after that move after that earnings call in May, which was obviously a very positive one, as was the one today, these are earnings beats, the stock took a gap up and then quickly corrected itself. And it stayed higher at the higher highs, but it corrected itself downward from that all-time high that it made coming off that earnings call. We're in a very similar pattern here where it's shot up almost 4% in post-market action since these earnings came out, and I'm expecting a similar correction reaction tomorrow morning off the open. So, and I think that the bids tomorrow will come in, prop this up even higher at open, and I'm going to be able to come in and swipe that.
I got you. I'm going
to take a 20 to 30 day bear call spread and take advantage of some of that call side premium. I don't know exactly what I'm going to do yet, but yeah, I'm going to be getting short Zscaler.
Nice.
Don't say that, Bob. But anyway, yeah, that's my risk of the week.
Yeah, I like it.
All we got for the risks this week.
I like the Zscaler. I think the premium is really solid in there.
This is just my favorite type of trade. Is the earnings overreaction play the other direction?
Yeah.
Because it's so. I mean, it's nearly impossible to sustain this kind of momentum, because it's like. Everybody, the earnings numbers come out, and everybody frantically works to price in this new information, as the efficient market does.
Yeah.
And then I just think that naturally winds up overextended, because as more and more people see the earnings call, more and more people come to buy, and it's just, usually you find that the momentum gets stepped on just a little bit after an earnings call of this nature. So, I'm just hoping for a slight, even just 1% move back down in the next 20 to 30 days. Probably going to do that closer to 21 DTE, as this is a very short-term sentiment that I have, and I'm kind of just trying to play an intraday correction tomorrow. Maybe I'll do a weekly. I don't know. But, that's where I'm at.
No, I mean, again, I like Zscaler. We'll see where the volatility is kind of sitting.
Oh, the tickers aren't 4 letters because they're on the New York Stock Exchange. That's a good call, Bob.
Yeah.
That makes sense.
Yeah. No, I mean, when it goes down to gold, GLD, whatever those might be, I don't know. It gets really hot in the kitchen sometimes. I know those individual underlyings. Usually I'm a little bit more comfortable in, instead of trading those outright futures or some of those commodities sometimes. That's why I like the Zscaler position. I was really debating on choosing something like a gold commodity or a different individual underlying.
I will say too. I hate this company. Not fundamentally.
Yeah, Zscaler. Why do you hate them?
It just frustrates me because we use it and it constantly keeps me from doing stuff.
Right.
And it frustrates me. Yeah. But we use it in our workplace.
Yeah.
Clearly people are using it and getting good use out of it. But then twice a day, I am like, Zscaler, why? I hate it.
I mean, the shareholders are loving it because post market 3 to 4% jump.
Man, screw the shareholders. Let me go on the websites I want to.
Come on, Zscaler. No, I know. We can start to jump over to the platform here. We'll check out Zscaler, see what they've been up to, see some of the market action.
You got gold typed in.
Hey, don't worry about. Hey, man. Don't worry about my gold over here. Just know me and my gold position are doing just okay. Where we at? $2. That's paying for commissions already. And
free trade. Let's go.
Free trade.
Exit.
Yeah, free trade.
Close it out.
Putting my stop at break even now. We're up a little bit. Don't want to lose any on this position. No, Zscaler has been a pretty volatile one. We had that little pop. Now it looks like we might open unched, as Dr. Jim would say.
Good word.
Yeah. But I'm curious to see how this options chain is going to be looking at in the morning. I think that, if IV's still propped a little bit and we're still kind of sitting near these highs, I'm not opposed to an out-of-the-money call spread. What is that conviction coming off of? Just the fact that if the risk reward is there, the IV is still high enough for Zscaler. I'm not opposed.
To this Kumu in our TikTok chat, yes, we are coming to San Francisco very soon. That's what?
It's this Friday.
This Friday.
When are they dipping out? I don't know when they're dipping out yet, but I know it's this Friday. They're going to be in San Francisco. It's been a little while since they then replay the morning show this morning if you missed it. They spoke about a few details
this Friday, San Francisco, completely free to attend, live trading event. Come hang out, come network with Tom, Tony, and all of the other wonderful attendees. We had a blast at the Chicago event, and then this one will be a similar blast. How about that? Thank you, wonderful production team. Hot damn, we're great. You guys are the best. We pulled that art card out super quick. But anyway, yes, San Francisco on the agenda. We can go back to our scheduled programming.
Yeah, we can go back to the schedule. One thing I will say is Tom is a good public speaker. Man, I feel like there's a skill that you can kind of learn and get better at. But that was my first time seeing him speak in person, and although obviously he's on the network all the time, I was like, dang, bro, there's levels.
No, yeah. He did a great job. I mean, it really was, unbiased opinion, it really was as promised. It is fast-paced, it's high energy, it's great conversations.
It's fast-paced.
It's worth it.
Oh, no.
Oh, Bob, you're going to the NYC event? Heck yeah, man. Happy to hear it.
No, Zscaler right here.
Yeah, Zscaler. So this is the weird price action that I'm talking about. This gigantic green candle that you notice in the middle of the graph here.
It's a Drake candle.
These are what? What are these time frames here?
Oh, this is a 5 minute.
Oh, this is
it's a 5 minute Drake candle.
Oh.
And then.
Man, you're screwing me. You're making me make incorrect observations here.
Oh no, there we go. I thought you were talking about the Drake candle.
Now give me I need to see the move in May. Show me some long term.
Let's zoom out a little bit. Let's get a little bit of a larger perspective.
Yeah, give me some days, give me some months.
There we go. This is the last 365.
Perfect. Yeah. So you can see this massive run up that took place in May, and then their earnings call at the end of May, which led to these two big fat green candles that make that gap up. And then you see, we took the gap up, and then we kind of just have slowly worked our way back down as the market prices in the fact that we may have overreacted to that earnings in May.
We may have overreacted.
It's entirely possible that a 25% move on a $250 stock is a bit much for an 11% beat on EPS. Then we just gradually ran back down. So this is sort of also kind of clouding my logic of how I want to attack this, is that this down move didn't come quick. Like it took a month or so before we kind of began to get that correction. And this move is a lot less pronounced than that move. So I'm debating. That's why I'm so indeterminate on my time frame here.
Let me pull up the IVR, see where this has been over the course of the last year or two. Kind of get that pump into, into earnings that we see here with IVR. IVR we're seeing around 50s, 60s at some point. We'll see what the vol crush is looking like into tomorrow. It's going to look like we're getting kind of a flat move on Zscaler.
Someone just sent us a gift on TikTok.
Oh yeah?
Thanks, Aaron.
Hey, shout out to Aaron.
Aaron, you a real one.
Yeah, Aaron.
Love you, Aaron.
Appreciate you, Aaron. With that being said, I want to go back to a couple of these positions real quick. RKT was another risk of the week that we had put on. It still has quite a bit of time on it. I think it has 17 days left.
That was short, right?
Yeah, it was. We had bought a put. It was super cheap. It was one that had just popped off that popped off that one day. I think it was going crazy on Reddit. But that one's been really boring lately. It is a cheaper underlying. But just a quick update on that one. And then we got NVIDIA. We had sold an out-of-the-money call spread on NVIDIA. And I will say, I'm not trying to sit up here and glaze Tom, but Tom did have a perfect call out on NVIDIA on CNBC Live, I will say. And it popped back up on my feed the other day, and I was like, oh, I forgot I put on that NVIDIA trade, but I sold the out-of-the-money call, and we kind of got that, like, unched type move, kind of how much more can NVIDIA take? Like, how much more is it not, all the conversations with NVIDIA. So NVIDIA is starting to roll over a little bit more now here, and maybe we can milk those contracts for a little bit more. Other than that, we got SPY. Sold an out-of-the-money call spread on SPY, 17 days left till expiration. Break even pretty much on that trade right now. And we're going to have to see what the next few days give us before we decide how we want to manage some of these trades over here.
Yeah, it is just going to be very determinant, especially that some of those shorts. We're going to see if this is just like the bearish days that we've had in the past few weeks, where we just get this one day and then
I feel that vol spike. Just wait on it.
Yeah, I wouldn't mind some vol. It would hurt my portfolio, but like I'm in a position where I can restructure. I mean, like I said, my strategy has always been long until proven otherwise. Right. So if proven otherwise, I am able to pivot. But agreed. Long gold is where it's at. Oh, I see. It's the hill. this goober. Saw that segment on the CNBC segment with Tom and NVIDIA. Played it the same way, hitting on a short call spread.
Hey, good. And I just got to say, making a call like that live on a big platform is like, Tom's used to the lights, but to give your actual opinion, right, that's like one thing people always avoid on something like a CNBC is like, let me just not give my opinion to someone to be like, yeah, this is exactly how I'm playing it. It's like, okay, you putting your money where your mouth is. I see you. I see you.
But yeah, no, I mean, I agree. Yeah, it's a bold claim, especially on a stock like NVIDIA.
I know, because it could have gone either way. I mean, we could have had like a nasty short squeeze. Not that I feel like we've already seen that multiple times.
I mean, it's something that I've said before with NVIDIA is that like shorting, like why would I short NVIDIA? Like there's so many other things I could short that aren't the greatest company in the world right now. So I just, it's really hard to feel like it's time to get short on NVIDIA. So yeah, that's a bold claim.
I mean, I could play devil's advocate. This thing is way too high.
Oh, Emmett, okay. I didn't want to challenge that because I was pretty sure I wasn't sure that I was right, but I did think there could be some NYSE tickers that were four letters. But NYSE, it's also older. I have no idea how old the gold ETF is. So Oracle's Oracle's not NASDAQ? I'm surprised by that.
Speaking of Oracle, shout out to the trade idea, Emmett. But I mean, okay, Oracle has earnings September 8th. We'll keep an eye on that. I'll just say the IV is standing out relative to the other underlyings we have to look at this week at least. Let me see how these premiums are looking.
Oracle had kind of a run there.
Yeah, no, they did. Oracle's a sleeper.
Whatever happened with Circle?
CRCL.
Stop paying attention to this stock.
What were they doing?
Yeah, this is about what I thought would happen. Oh, man, I shouldn't have looked. I shouldn't have looked. I wanted to short this thing at freaking 300.
Circle, CRCL. Let's see what they're talking about. CRCL.
That's gross. I knew that thing was going to collapse, and I just did nothing about it.
That IV rank looks
Trust your convictions,
hideous.
people.
The IV rank is hideous. Absolutely. This is what we call basura juice. That's what we call that.
Trash? Trash juice?
Trash juice.
Trash can juice?
Trash can juice. That's what CRCL is right now.
Word?
No, it has absolutely died, though. Sucked all the fun out of it.
Yeah, that was an interesting one. Yeah, when they were rocketing off IPO, I wanted to get short at 300, and then I wanted to get short at 320.
Oh yeah,
should have just done it. It's frustrating. Wish I never asked. Wish I never brought it up.
I know we got a few moments left here.
Check my Forex positions.
Yeah, what's up with the shekel right now?
Oh, I forgot I liquidated everything. I got no shekel. I'm up 50% on my Forex portfolio.
Let's go.
Entire portfolio.
Shout out to shekel.
And I do not know what I'm doing, guys. if you've ever wanted to jump into FX and you're worried you don't know how, I don't either, and I just keep winning. You should give it a try and see what happens. My entire strategy is I just go through the watch list of all the biggest currencies against the dollar on a 1-year time frame, and anything that looks close to 1-year lows, I buy, and anything that looks close to 1-year highs, I sell.
Yeah.
And it works.
You got any shekel right now?
I have no shekel.
No.
Should I put on some shekel? I can check it out.
I just like the name. It's got a nice little ring to it.
I don't. That's like down here somewhere. ILS. I'm looking for it. There it is.
As we take a look at the shekel, still going to be keeping an eye over here.
See, this is right in the middle of a range. I don't know how to do anything when things are in the middle of a range.
Yeah, completely agree there. Just taking a look at NASDAQ as we wrap here. We're trying to rebound a little bit. I'm still feeling pretty bearish, honestly. I mean, if we keep rallying personally, might start to look to get on a little bit more short delta. Even maybe just put on one short contract on MNQ and let it ride if the risk reward is there, especially with how volatile we've been. But I digress. We got a few minutes left. Anything else to touch on before we start to wrap here, Gus?
No, nothing else to add. Bob, great tidbit here. It's just mainly tradition on the NYSE. Nothing's a requirement, but NYSE typically 3 and NASDAQ typically 4. That's a good tidbit. I don't really trade currencies either, but I just put on some short Japanese yen. I'll tell you, Bob.
Nice.
Let's do it. I don't know.
Some short yen?
I don't know what the hell's going on. I'll take some short yen.
Look at these guys flexing on outside of regular market hours.
Oh, yeah, this thing looks way overextended.
Guys, if
sell.
We could get into some futures, guys. Don't let them have their shekel.
I'm still like a little.
Let them have their Japanese yen.
Still a little confused on exactly what a pip is, but I know how to input the trades. All right, $200. Controlling 30 grand of Japanese yen.
Okay.
In the account.
We got some yen?
Yep.
Okay. Were we short or long on that?
Short.
Okay, I like it.
We're short the yen.
Okay.
Bob, gospel. I guess I would say. Congratulations, your position is a winner. I am still undefeated in my lifetime trading Forex without ever having any clue what I'm doing.
Undefeated champ. Anything else?
6-0. I think 6-0. Yeah.
Bro, that's Mike.
6-time.
Some Mike numbers.
Yeah, I gotta get a ring.
6.
Put it on my desk.
6.
6 rings?
6.
Expensive.
Anything else to add? 6-0.
He steered me right on Ohio State. Hope I can reciprocate. Good, Bob. Happy to hear it. Yeah, let's do this. This works. Did he short yen futures or the spot? The spot is the answer. The currency itself on TastyFX. Great platform. You guys should check it out. Anyway, no, I will let Errol do his outro now. I do not have anything else to add. Errol, take us home.
What was it? Short Japanese yen. No, we got gold risk of the week. We got some Zscaler. We'll see how the Zscaler earnings pans out, and we'll see how the rest of these underlines are looking by the end of this week. That's going to do it for Risk of the Week. Thanks for taking the time to hang out with us. We always appreciate you guys. Be sure to stay tuned for more segments coming on next. We'll catch you guys next time. Peace.